meeting is being recorded.
So, risk is the first thing that we're going to talk about. And look, I'm going to be straight up with you. This is probably the one subject that people have probably most, and I'm not, if I'm setting out my stall incorrectly, I'm sorry. But what risk is initially based on is accounting. Is that all right? And if you looked at the course and the course spec, it is accounting. All right. And credit controllers, I know, are not accountants, do not want to be an accountant, never wanted to be an accountant, and still don't. And the whole concept of accounting and finance is just, I suppose, to a large extent, is opposite to what we're doing in credit. And it really is. And the more you think about finance and credit within the finance function, because it's always an uneasy fit within the finance function as well. And that's because we are the exact opposite to all these guys. Accountants, when you think about it, accountants are looking backwards and reporting on what has already happened. Yeah. You and I don't care what happened. We wonder, can you pay me next month? You know, so we're always forward focused. We're looking after future issues, targets, cash, money, security, all the stuff. So we're all the time looking forward, whereas accountants are all the time looking back. So that's part of where the difference occurs. The thing about, and I make no apologies for it at all. To me, I think this risk module is, and the reason we've left it in, and even though it can be initially unpopular, you know, it is worth sticking with. All right. Because if you're working in finance, it's good to have the language of finance, to have the knowledge of finance, to understand what's going on. At some stage in your credit career, somebody is going to throw a set of accounts on your desk and say, are they good for 20 grand? And if you're like most people, like a set of accounts is like looking into a field, like it's just all these pages with numbers and you're going, like what? And the reason for this course is that to give you some method of making sense of the figures. Are you with me? So that's really what we want to do. And what we want you to be able to do is, having completed the course, and part of the exam process would be, we will throw a set of accounts at you and say, are these guys good for 50 grand or 30 grand, or how much do you think they're good for? Is that okay? And what you will be able to do is to be able to look into the accounts and do, and we give you all the tools and tips and calculators and methodologies and all that kind of good stuff that you will be able to make a reasonable assumption. Are you going to get it right all the time? Of course you're not. Are we still going to have bad debts? Of course you are. That's just the world that we live in. Hopefully you will be able to make better decisions. You will see more of what's coming down the road. And we can hopefully, when a company does go into liquidation, which it's going to happen in increasing numbers over the next 12 months. Just wait and see. We're in for, I think, a horrific time in the next year. That's just me. And the fact that the tech companies are getting what they call recession ready, that in itself is causing a recession. Yeah. So when all these people are being let go, these high paid jobs, you know, that kind of reduces the amount available that's flowing in the economy, which impacts on the coffee shops and, you know, and it all sort of filters all the way down. So I think the next year is going to be difficult from a credit perspective. So we just need to be wide open. We need to be looking at the trends. We need to make sure that we get paid when we should get paid, and then that we manage the risk and we understand the risk.
Okay.
So that is it. So please stick with it. And particularly, like all the other subjects, there's 4 modules in risk. The first two are really, you think I didn't sign up for an accounting exam. So they are accounting based. What we want you to do, and this is very, very important, the first 2 modules are building up to what was formerly called the profit and loss and balance sheet. So they are the two key documents that you need to concern yourselves with when you're analyzing a company performance. So, and to explain, number one, where they come from. So how do we get to a P&L account? Where does the information come from? So sorry, that's Angelina me. So module one, the 4 parts within module one. So we just, and the history and background and concepts and terminology, this is for your information, okay? And we want a lot of this to kind of wash over you. You don't have to swat and remember every line and every definition. Are you with me? We just want you to understand the concepts. And a lot of people, so there's nothing to be learned off by heart. So if you understand, like, accounting is very simple. And I think it's very simple anyway, that in a business, when you think about it, money comes from somewhere and it goes somewhere. You know, so I want to set up a business with 10 grand. So fair enough. So the 10 grand comes from my pocket, which is capital, and it goes into the bank. So getting caught up on debits and credits and credit this and debit that, and you're going, here. No, look, it comes from capital and it goes into the bank. And if we buy a car for 5 grand, wish you luck with that one, then the 5 grand comes from the bank and goes into the car because we put the money into the car. And all accounting is recording where the money came from and where the money went to. And so we'll go through step by step all the different two-sided entries and the individual accounts, and the difference between assets and expenses and liabilities and all that good stuff. And just to go through the concepts, terminology. Then so we kind of start a business day one, and we go through the accounting equation. And the accounting equation is good. And look, it's just there. Because it enables you to work with incomplete information. So once you know the accounting equation, if you know what the capital and assets is, and you want to work out what the liabilities, there is a way of doing it. And a lot of the time, credit people are working with incomplete information, so we need to know how to do it. So that is that. And then we go right through to what's called the trial balance, where we extract all the balances from all the different accounts, and hopefully it'll balance that we've put everything in correctly. And then we now just, yeah, I should let you know as well, and maybe I should clarify this as well. What the accounting bodies did in the last year or so, profit and loss. So if you're looking at historic information, you're looking at a profit and loss account. Yeah. Mm-hmm. And that's probably what you're familiar with. In new parlance, so going forward, the profit and loss account is now going to be known as an income statement. Is that right? And what the accounting bodies are looking to do is to standardize terminology across the world. So whether you're looking at an American set of accounts, a European set of accounts, or whatever, it's all going to be the same. Is that all right? So that's really what, yeah, I just put that in there as well. So there's the loss account. And the other thing as well, yeah, the income statement. So the income statement are P&L accounts. So not to get confused, that is fine. And what then we'll do in terms of final accounts. So we'll put that together, and like a trial balance is only a list of numbers. What we want to do is we want to get it into an order where we can make sense of it to see, is the business growing? Is it failing? Is it profitable? Is it not profitable? Is it worth money? Is it not worth money? That's really what we want to do. So preparing a profit and loss account or an income statement is just about taking the information from the trial balance and putting it into a format that makes sense. And there is a standard format that you will learn, and hopefully it'll make sense to you. So that is, so we bring you all the way up to final accounts in the income statement. And the other thing, and hopefully this will help you as you're going through the notes, the profit and loss account, just always remember this, because like we look at the profit and loss account and the balance sheet, and those two things sit beside each other. they are completely different animals. The profit and loss account tells you what you bought and what you sold in a period of time. So if the year end is the 31st of December, and it can be any month, if it's 31st December, it's what you bought between the 1st of January and the 31st of December, and what you sold in that period. It's only dealing with that period in time. Is that okay? Because sometimes people get confused, well, why am I making adjustments and why am I doing this? Because it only relates to that period in time. So the sales figure that you see on the P&L account is all the sales from the 1st of January to the 31st of December for that period. Yeah.
Okay.
So that is what we're looking at there. When we look at the balance sheet, which we'll do in module 2, so we move on to the final accounts, and and the balance sheet again, just I put this in brackets here because that's probably the that's probably the terminology you'd be most familiar with. So the balance sheet is now known as the statement of financial position. So what your statement of financial position, your balance sheet, is just a list of everything the company owns and everything the company owes at a moment in time, which is close of business on the last working day. So if somebody went into the business at midnight on the last working day with a camera and went click and just took a picture at that moment in time, because your assets are moving, you know, your debtors, there's money coming in, there's debtors, there's sales going out, so it's constantly moving. So what we do for the balance sheet is we just fix it at midnight on the last working day, boom, and we take a picture of what the world, and that gives us a list of what we own and what we owe at just at that moment in time.
Okay.
Is that okay? And once we know that picture in time, then and this is where module 1 and module 2 will go, starting at the base, individual accounts, debits, credits, up to the trial balance, up to the income statement, up to the statement of financial position. And now you know what everything is, where everything comes from, where it all goes to. And your first assignment within risk will be, you'll be given a trial balance, a mythical trial balance from a company, and you will be asked to produce a set of accounts for them.
Okay.
Right? So it'll involve, you know, putting them into the correct format and adjusting them appropriately and accordingly. And hopefully by then you will know how to do that. And if you don't, that's where the revision session can come in. So if 2 or 3 you say, look, would you mind giving us an hour just to go through the assignment before we submit it? I'm quite happy to do that, and Angelina will be as well. Is that all right?
Yeah.
So that's that. So now we have the profit and loss and balance sheet out of the way. We understand what it is, where it comes from, and everything about it. Now we're ready to move on to, I think, the fun part of module 3. But then my idea, fun, I'm sad. So module 3, yeah. So module 3 starts off with cash operating cycle. So it's about cash flow and working capital management, because I suppose, having done the course, we want you just to be more than credit controllers. You are responsible for bringing the money in that keeps your company going. And what we want to make sure is that you understand all the aspects of money coming in and money going out, and cash flow in terms of making sure that the business stays solvent throughout the years. And to me, I said there was 2 main documents, which is the profit and loss and balance sheet. They're kind of historic documents. From a day-to-day perspective, cash flow forecasts are the ones that predict the future. And you'd be amazed at how well we can do cash flow forecasts, because we know how much money we have in the bank now. We have our sales targets that we know how much they're going to sell month on month. We have our credit terms, so we kind of know if we sell 100 grand to this customer in January, we will probably get paid at the end of February. You know, so by knowing the information about what we have in the bank, what we're going to sell, what our credit terms are, we can predict with accuracy what money is going to come in each month as we go through. And we also know that December people go missing for 3 weeks because this is Ireland, and Christmas starts on the 1st of December. And Christmas party starts sometime in September. So that's fine. And then we can just make adjustments accordingly. So we'll show you how to build a cash flow forecast, and then how to adjust it as well. So if we need to buy a 50 grand fixed asset during the year, by looking at our cash flow, we can think, okay, well, look, if we buy it in January, we'll run out of cash in March, whereas if we wait till July, we'll be able to afford it, that kind of thing. So it can help with our decision making as well. And the more knowledge you have and the more confidence you have dealing with figures, the more people come to you, and then the more valuable you become, and the more you which is what it's all about. So cash flow forecasts and statements, we'll go through that. And then we go back to the financial statements and we get into the analysis. Now, I know that sort of scares a lot of people, and it shouldn't, because analyzing accounts, to me, and if you get this, so it's not about the numbers, okay? What it's about is, what story are the numbers telling me? That's what I want to know, because I'm a credit guy and I like stories. So what story are these figures telling me? So you have a figure of 47, yeah. So what the hell does 47 mean? No idea. The thing about it is, and I'd say that 47 is their day sales outstanding. And you might say, well, Jackie, is 47 good? But the answer is, I don't know, because I don't know their business. I don't know who they are. I don't know what's going on. Do you know what? If their day sales were 63 2 years ago, there were 52 last year, and they're 47 now. Yeah, these guys are going in the right direction. They're hammering their debtors. They're getting their money down. They're getting paid quicker. Yeah, that maybe that 47 is a good idea. If their day sales outstanding was 32 years ago, 32 last year, and 47 this year, maybe 47 is not such a good idea, because can you see? So it's not just the number, it's the trend of, are they getting better or are they getting worse? So that's what we have to look at in terms of making sense. And the ratios, now you can be bamboozled with hundreds and thousands of ratios, and if you buy accounting books, there'll be thousands of them. I think we deal with 12.
Okay.
That's all. And in my whole career, they are the only 12 that I have ever needed to make sense of a business. Because there's things I need to analyze, and there's things I don't need to analyze. And sometimes, and let me forewarn you about this, because you are doing risk and it is accounting based. And if you make the mistake, or maybe it's not a mistake, of talking to your accountants, a lot of the stuff that I will tell you will be the exact opposite to what your accountants will tell you. Is that
Why?
Okay? Why? Because I have a different way of looking at things. You see, accountants are looking at things from the business perspective.
Okay.
So, for example, an accountant will say to you that, we're talking about debtor days. Let's look at the other side in terms of creditor payment period. So how long it takes you to pay your suppliers. An accountant will tell you the higher that figure is, the better it is, because as a business, we get to hang on to the cash. And if we can hang on to that for as long as we can, that's in the interest of the business. And that's what we want to do. Yeah, we want to keep as much cash as we can in the business. So the higher the creditor payment period in the business, the better that is for our business. And they are right, it is. I'm a credit guy, and I like customers who pay their bills on time. So if I can see that their creditor payment period is getting longer and longer, I see that as a bad thing, because I'm going to be one of these creditors. And if they're taking 107 days now, I can't live with that.
Yeah, you can stop the plan.
Maybe I can. And maybe if they are Tesco, who give me a 2 million quid order, maybe I'll make the arrangement somewhere. I'll find funds somewhere to keep it going because of the profits they're going to make in the future. So, you know, like business, like we give credit, and we give credit to sell more. That's the whole point of giving credit anyway in the first place. So we are a pro sales, pro business, pro profit function. And part of what we want to do in risk is to be able to make intelligent decisions based on the facts that gives us a sporting chance of getting paid, and then to put the pieces in place if we don't. That's really what it's all about. And by understanding, so I said about the 12 ratios, the three things that I'm worried about within a business, or the three things I'm concerned about within a business. One is liquidity, and that is their ability to pay their bills. So whereas an accountant will look at, the profit of the business is the most important thing, or the turnover. And if you listen to all the business news at the moment, the growth rate and growth levels, and they're all about growth and growth and growth, and as if this is the be all and end all. And the other thing that they look at in the balance sheet is the net worth of the business, how much the business is worth. And they get all hung up on net worths, and they get hung up on profits, and they get hung up on turnovers. You know, as a credit person, that's all very well, and you're an accountant and you're great at what you do, and you do what you do. To me, like, I am not impressed with growth. And if you double your sales in the year and you double your debtors because you're selling to brats who are never going to pay you, and you're never going to get paid, like, that's just stupid business as far as I'm concerned. And yes, you might impress the markets with your growth. If you don't have the money to pay me at the end of the month, then I'm not, and I'm the one you need to impress if you want me to supply it. Do you get that?
Yeah.
So what I will tell you is, and your accountants might laugh, to me, liquidity, the most important ratio in any business is the liquidity ratio. How much can they afford to pay their bills on time? That's all I care about.
Yeah,
and the only reason I look at old accounts is to show me the trend. Is this a good business? Is this a failing business? That's all. And now, can you pay me next month?
Yeah. Okay.
All right. So liquidity, ability to pay their bills, profitability. The more profitable they are, you know, the more the business will sustain, which is fine. We're looking at 2021 accounts at the moment, guys. Of course, a lot of businesses made a loss. You know, we had COVID, we had pandemic, we had lockdown. So am I going to get hung up on? No, I'm not. And if they lost money, boo-hoo. You know, they'll get over it and they'll jump back, and some will and some won't. And, you know, but we look at, you know, how they've been doing since. And management efficiency is how well the business is being run by management, how they're controlling their stocks, how they're controlling the business. So are these guys in control of what's going on? And there's sums I can do looking at the P&L and the balance sheet that will give me an indication as to how that works, and how the business is run. That's what I'm interested in. Is that okay?
Yeah.
And again, you don't have to learn any formulas. They'll be on a page in front of you. They're even included in the exam paper. So do you have to remember them? Absolutely not. You know, you do have to understand them. And I suppose that's the important part. Then module 4 really is where it all hits the ground. So what we'll introduce you to is a scoring system. So once we understand the accounts and where they come from, we understand the ratios and the formulas and what they do. Now we're in a position to build a scoring model based on the ratios that will give me a single number to say, you know, am I happy doing business with these people or not? Yeah. So there is, and Z scores and comparative scoring and all that kind of stuff. And I know sitting here, and a lot of you probably haven't done accounting before, and you're going, here. No, honestly, once you take it step by step, and again, they're just formulas. And to be honest with you, the comparative analysis and Z scores are only spreadsheets. You know, so yeah, they can be done pretty easy. Pop in the numbers, and you get the spreadsheet will make sense of it. Is it going to do everything? Absolutely not. Because there's other elements to risk as well. And in fact, you're going to cover them off in credit management, because we look at the financial risk within this topic, and the non-financial factors we look at within credit management. So, so we give you a full overview of risk as well. So that's that, and classification of risk as well. So it's always a good idea, and very few people do it, where I have a ledger with all thousands of balances, to say these are the high risk ones, these are the low risk ones, these are my middle and ones that I need to keep an eye on. And rather than doing everything and having orders going on hold left, right, and center, and I'm working so hard, no, stop. Like, these are my low risk customers. They will always get stuff no matter what happens. So, we switch that off. We let them get whatever they want. These are my red lists. I have to check the banknotes before I'll take them off them. Like, they're not getting credit. And I'll even check the notes before I accept them as well. So they're the red list, and then the ones that we need to keep an eye on and watch them. So by classifying risk into medium risk, high risk, low risk, it just helps us to manage it as well. Is that all right? And establishing industry norms and best practice, and again, that's pretty easily done as well, because if I have a scoring system and I put in 3 sets of numbers, 3 different companies into it, then it becomes very clear when the sums are done. This is the best company, this is the worst company, this is the middle one. Yeah. So, and I can use that for any other. So I get a new company in, pop them into the model and say, oh, look, they're better than my best guy. I love them. Or these guys are worse than my worst guy. We better keep a close eye on this fella, So, and that really is just to alert you. Does that all make sense? And then, and I'm still sad about this sort of finishing the course off on a negative note. I suppose we do have to be realistic, and businesses are going to fail. So we'll go through some of the warning signs, and some of them, once you see them, it's like a big red flag. And I would honestly say in my years as a credit manager, 2 companies went just out of the blue. And I remember one was a bakery in Northern Ireland. They paid on the button every month, bang, 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 bang. And then I got a notice say they'd shut down. And I just couldn't believe it. And I still haven't got over it. Everybody else who went, I could see it coming. There was the delays in payment. They were hard to get. They bounced direct debits. There's a trail of destruction. And then eventually they go bang. So it's just knowing to watch those signs, and then pull out just before they go. That's what it's all about, and just before they go. I remember meeting a guy in the Construction Industry Federation. It was a time when who was it? Pierce Constructing, biggest construction firm in Ireland. During the 2000s, probably one of the biggest contractors in the city, and they went bang, owing millions when the property crash hit. And I remember talking to this credit manager, and he came up to me and he was trying to impress me. I don't know why. And he said, oh, did you hear Pierce went in? And I said, yeah. And I said, there's a lot of worried people out there today. He said, not me. He said, I saw the writing on the wall 10 years ago and I wouldn't supply them. And I'm one of the guys out here now that has no bad debt to Pierce. And I just said, oh, yeah, it's good for you, and walked away. And I just thought, like, these have been the best 10 years in the construction industry, and Pierce were at the front of it. How much sales could they have made, and how much profit could they have made in the last 10 years? And they continue to supply them. And, so not all bad debts are bad. Are you with me? We have to make commercial decisions and make sure that we're, when the end comes, that we're in the best possible position at the end. Sometimes being that sort of saying no all the time is the worst thing we can do. And if we can do the business, make a profit, and then build up our provisions, and we do talk about provisioning and bad debt provisions and all that good stuff within it, then I think it's in the best interest of the business. So that's really what it's all about. So that is that. So we do have to cover bad and doubtful debts, cost of bad debts, and all that good stuff. I didn't include it. Maybe I will for next term. I have a model on how to increase your bad debts, but maybe that would confuse people. So that's that. And then in terms of business failure, this over trading, a failure prediction using financial analysis. So there is Z scores and things that you can do that will tell you how long a company has to live, which is pretty accurate. And even though it was created in the 60s by a man called Edwin Altman, it is still as valid today as it was back then. So that's something we'll share with you as well. And over trading, this is where, you know, when there's an upturn in the economy, and people take orders, and then they're under pressure to, you know, and if they're not collecting the money that's out there and their business is going up, by the time the suppliers are looking for their money, they don't have any money to give them. Are you with me? And so they've loads of sales and loads of debtors and no money in the bank. And that's why companies go into liquidation. They go into liquidation because they run out of money. Not because they made a loss, not because their net worth is reduced. It's because they run out of cash. Yeah. And that's something that we have to watch. And once we can see the accounts, and even once you get this, and if you have high risk accounts, that's high value accounts, once you know the models that we'll teach you, you can get monthly management accounts and slot the numbers in and see if they're getting better or getting worse, or if you need to worry about them, you know. So that's part of what the whole course is about. And I just think it's so important from a credit perspective. It's great from a confidence perspective, knowing and understanding the terminology of accounting, being able to look at a set of accounts and think, yeah, I'm happy giving them 50 grand, or, oh, hold on, you know, I've questions to ask here before I do that. Because the amount of people who just rely on, you know, Credit Safe or DNB or whoever, oh yeah, well, you know, VisionNet say they're okay for 50 grand, so I'll give them 50 grand. You know, I'm not handing over the management of my business to any collection, you know, information agency who's, no, like, I need to make my own decisions. And what will happen in this course is it'll give you the ability to make your own decisions. And then you'll see sometimes how wrong the agencies are in their analysis. So that's that. This, and I don't know whether you can see that or not. This is just the first page of your workbook. So your workbook says you have 25 grand in liabilities, 80 grand in income, 120 in assets, and your capital is 45. How much were your expenses? Now, I don't expect you to know that, because if you did, you wouldn't have to do the course. So that's the kind of stuff. So this is working with incomplete records and working out what our capital, what our liabilities are. And once you read the first section of the first set of notes, by getting the accounting equation, you'll be able to answer that. So that's just kind of what it looks like. And what do the short tests look like? The short test looks something like this. So we'll give you a question. So again, calculate missing figures and all that kind of stuff. There's an extract from the balance sheet. This is your opening stock. What's the value of the gross profit and margin? So just be careful of that. That's a sneaky little one, because it's asking you for two things. What is the value of gross profit and the margin percent? So we want the gross profit and the margin. So read the questions carefully and just slot in your numbers there. And to be honest with you, you will get your short tests. He says, hopefully, yeah, I think you get them in Excel format. So we'll send you the short tests as an Excel. And you know what? My advice, this is not a requirement, but my advice is probably best to do your answers in terms of formulas. I don't know, now it's not an Excel exam or whatever. That if we can see that, you know, the answer is, you know, this plus this plus this plus this minus this, then, you know, okay, they understand it. Because if you give me a number, or Angelina a number, that number is either right or it's wrong.
Yeah.
And if it's right, you get the marks. If it's wrong, you get no marks. If you put in a formula, and look, you just covered, you did that plus that minus this box here, you you put in D instead of C. Now, but I can see from the formula that you understand what you're doing. You just picked the wrong box. I might be able to give you half a mark for that. But you had the right methodology and you had the right thinking, and you just, forgot to carry the one or whatever the case may be. We can see that. And we can also see that these people haven't a clue. Why are they adding, fixed assets to wages? Because it just makes no sense at all. So they obviously have no idea what's going on here. So these are the first 3 questions in the short test, and there's 10 questions, and you say you will be able to answer those.
Okay.
So that is that. So I said I'd keep you till 11:15, and it's only 11:11 now, so that's not too bad. Does it all sound? I hope I haven't frightened you. I hope I haven't put you off. I'm hoping that you're up for the challenge.
Absolutely. Yeah.
And stick with it, and there are times, because it's alien, and the one bit of advice I get to you is, please, there's 2 parts. Number 1 is the perfectionist in you that wants to get 100% in everything. So park that perfectionist somewhere. You only need 40% to get through. So you don't need to be perfect. The other thing is, the people who struggle most initially in this subject are the people who overthink it.
Right. Okay.
Just take it step by step by step. So here is a supplier, and you bought 100 quid's worth of stuff off him. So what happens is, so our stock goes up by 100 quid and our creditors go up by 100 quid. Credit control is saying, oh yeah, but sure, we have to pay them. No, you will at some stage in the future. Just take it one step at a time. For now, we're just recording. Oh yeah, but then that'll hit the bank because we're going to have to. No, stop. You're taking it 3 steps. You're going from getting stock to paying your bills. Just take it step by step. So we get the stock, it goes into stock, goes into creditors. Then when we pay it, it comes out of creditors and out of our bank. Do you know what I mean? So, and you'll know, any good accountants, they're slow and methodical. They take 1, 2, 3, 4. Credit controllers tend to go to the bottom line. Oh, just show me the bottom line. Forget all the detail. Just give me and we like to sort of cut out these boring steps and just go straight for the jugular. It's in our nature, and that's why we do it. So if you take it step by step and overcomplicating it in your own head, it's simple concepts, and anybody who overthinks it and saying, oh, well, why is this, and what, and if there was 23% VAT, look, if there's VAT in the question, we'll tell you about it. If we don't tell you, just ignore it. Like, don't be saying, oh yeah, but there's VAT in here and it's not there. No, it's just stick with the question you're being asked. So that's my little rant for now. So look, I hope you enjoy it. I'm going to stop the recording here now to give you an opportunity to ask questions. Stop recording.